Not surprising given that we continue to see these warnings coming from global organizations, including the IMF, saying that the global recovery could start fading. This GTV chart on the Bloomberg Forward Viewer is showing the latest forecast, and it's still of a contraction of more than 4% for the world economy. How will this affect the markets, though? Because there seems to be still a very big disconnect there.
Yeah, it does. A lot of enthusiasm over the vaccine news, and rightfully so, right? The sooner we can get something that's very effective distributed widely, the sooner we can get back to ordinary life. And the problem from our perspective is that we first have to get through winter. Right, and this is setting us up for some downside economic surprises. The story so far has been positive surprises, right? After the expiration of the enhanced unemployment benefits back at the end of July, there was a wide expectation that you'd see consumer spending taper off, and that didn't really happen. There continued to be positive surprises, but now with renewed restrictions on activity, lockdown light happening across Europe, we think that there is a significant chance that we could see these negative surprises. Now, the big question is whether that will actually phase the market or not. One of the things that we look at are some of these macro factors and how that gets paid attention to or priced into securities. And it seems like, at least for the last 2 weeks, whether it's inflation surprises or economic surprises or changes in real rates, it hasn't really mattered much.
Perhaps because you have the backstop that the virus vaccine is coming at some point, right? Does that mean that you're still positive about this rotation towards cyclicals, towards those sectors that will see the most growth if the economy rebounds?
Yes, we are positive on cyclicals, and going into the presidential election, we were anticipating that around about that time or shortly thereafter that we would start hearing about some of these phase 3 trials. The results could start trickling in. And so we were expecting that we could see some upside and maybe a big rotation in the market from more of the large cap growth area to more of the small cap value. So that's the way that we've been positioning portfolios. And we expect that it does have some room to run. If you look over the last year, I think large cap growth has outperformed small cap value by like 20 percentage points. Over the last 5 years, it's a margin of about 50 percentage points cumulative. So we think that this type of rotation, it can continue. And so we're willing to ride that wave of optimism that's on the back of this vaccine news.
Given the tensions between the positivity over the vaccine news, the concerns that virus cases are rising and the pandemic isn't being handled still in the US, is it better off to look at opportunities in emerging markets, particularly as the dollar continues to see that weakness?
Yeah, that's actually one of our favorite areas that we began adding to across a lot of our portfolios, depending upon the strategy and the mandates, is that emerging market exposure. For about the last 3-4 years, we were interested in the emerging markets, but it seemed like they just kept getting relatively cheaper and cheaper compared to the US markets. But now, if we do actually get this global growth, and it's synchronized, we think that can redound to the benefit of the emerging markets. And from our perspective, there is a good enough valuation discount there such that we can ride out any sort of volatility in case the market does tend to focus one day or the next on any negative economic surprises. We think that this market recovery, this economic recovery has a lot, long legs to it after we actually get an effective vaccine. We're very encouraged by the statement from the G20 about their commitment to making sure that they're sharing the vaccine, that it's going to be widely distributed. So we think that that can really contribute to this synchronized global recovery that will hopefully last not just a matter of months, but actually a matter of at least a couple years.
What do you like then in EM? Because obviously they're not all created equal. Would you be more prone to look at the opportunities in Asia, given that that's really where we have seen a better handling of the virus?
Yeah, so this is where we're a little split, because it seems like if you do break up EM, there's China and almost everybody else as far as how things have gone. China seems to have a lot of momentum behind the market, but higher valuations, but it's probably justified on the basis of how aggressively they were able to handle the vaccine and get industrial production, retail sales, kind of on a more positive trajectory relative to everybody else. But we do think that there's still some good value in EM Asia. We are still positive on China, but beginning to add more towards areas like, say, India, where we think that the virus hasn't been quite as well contained and that there could be this bigger rate of change as far as the improvement that we could see. But when you look across, say, EM South America, Latin America, and then Europe, Middle East, and Africa, to us, that's where there's maybe some deeper valuation discounts. Some of it is maybe for a good reason because it's politically driven. And that's always one of the challenges with EM is that it is really an eclectic mix of economies and politics. And so that's why our exposure tends to be more on the active side, working with our active management teams to try to navigate some of those lurking challenges across a lot of those countries.
And the strength that you see in those EM Asian assets especially, how much of it is to do with the fiscal and monetary support that they're given, and how much is it because of just earnings potential?
Yeah, they're really inextricable, as far as to get that earnings potential has required some of this fiscal and monetary stimulus. Interestingly, if you look at, say, yields in China, at least relative to over the last 12 months, they're actually towards the upper end of the range. So a lot of the support coming out of China has been more on the fiscal side, not necessarily so much on the monetary side. But that's very different, of course, when you look at other countries that have been aggressive with both the fiscal and the monetary side. And we think that that type of stimulus support will have a long tail. Yes, it has improved optimism as far as knowing that policymakers are watching the problem and supporting it. But monetary policy operates with long and variable lags, which is one of the famous dictums from Milton Friedman. And so we know that that can actually have a longer term positive effect, and it's not just a short term boost. So that's one of the reasons why we don't think that the stimulus has just been this flash in the pan. It's actually been like a bridge to get us from pre-COVID to some type of recovery after COVID.